After going through all of this analysis, it seems that everything is backwards and crazy and most likely manipulated to be that way. We live in a world where we just endure these manipulative moves and accept it. And I do because I sometimes feel bad every single time I buy physical silver and I'm able to get lower prices. Thank you for watching and have yourself a great day. And finally, this is the net result. This, of course, being silver, not including those two segments, which were, of course, that of the margin calls. And we can still draw these interesting little trend lines within this and state that we are in an upward trend. Granted, it's not as strong as the trend that occurred back before the manipulative crashes. So this is what we're seeing now. We've eliminated already one form of major crashes, if you will, times two, and we have the other part of the correctionary phase, which is still not as strong as the entire run from the start of the year until the end of April. We also know that the current price today is roughly around 34 or so. And the prices in here before this all took place was roughly at around, we'll say 47. So the difference from 47 to 34 is 14. That would work out to about 30%. It is lost. But it is also gained from this point being at around 57. That's another gain of about 20%. So we've pretty much had about a 40-50% drop on the price purely only because of the margin calls. In the final segment, I'm just going to go over a conclusionary statement. And this is the start of the year where the year opened at $30.93. So that will be the number we will be using to state will we have an up year or a down year. It's going to be a challenge, it seems, for silver this year, as gold, not as much. But anyway, we got all the dates and the prices. This is the daily chart for silver, actual results. Nothing manipulated here. Nothing. And now the manipulation will start, basically, on two different fronts, of course. Therefore, the manipulation here is I've taken these percentages that I showed in the previous segment, and I've increased it so that the real movements that occurred on the non-conceptual manipulated days, although really they were manipulated as well, but on the non-volatile days that I was talking about, they are they are the only ones that are included. The two sell-offs are not within it. To find these calculations, what I have on the right hand side are the movements of the highest point, lowest point, and the close. So within this day, from the point that it opened, the highest point it was 2.84% higher. This can never be a negative number. It sometimes can be zero. This is the lowest point. Again, this can never be a positive number. It can sometimes be zero. Here's one case. Only way this is the case is if the open is the lowest point of the day. Same thing for here. And this is how much it closed for the day. I've eliminated all of this. It's not needed, but on the in another spreadsheet, I can move these variables in, and that's what I'm going to do in the next segment. This is the daily data for the silver market, and we're looking back at the previous days of the year, February, and this line in the right-hand side indicates the percentage move between the day from the highest and lowest point. So we can get an indication that we expect most days to be over 2%, probably average between 3 and 4, with some occasional days higher. That's normal volatility. Sometimes you'll have some lower ones. There's a 1.5, and You can check to see what kind of holidays occurred within it. April the 7th, that's usually an Easter type of day, basically. So here we have those big moves. Before, the price action was in or around a 45 to 49 variable, basically. And then we have 13%. It, when does it calm down? Well, there's 7 here, so you would really have to think that it would calm down from this point in here. So what we're going to do is eliminate all periods from here and just state they never happened. And we'll do it with one more, which was the one that occurred again. We'll look at these days again. Tell me when they look like they get out of control. Was it here? Probably 22%, 19%, and 12% days. There was 5 days in a row with 10% moves. So price action the day before, right, these were normal days in here. And the price action was in the $38, $39, $40 range. So we're going to eliminate these big days again. Now, when does the volatility really come to a close? This one is easy because we can see somewhere like there. Boom. In the next segment, what we're going to do is take a look at what the chart would look like if we just put them together. But before we do that, we're going to show how this can be done. When the margin moves occurred, we had a nice uptrend, and then it was pretty much a bloodbath for a few days, and then it even had some follow-through volatility. But we can notice that the trading that occurred within this gap from point A, which was a selling, and point B, which was a second round of selling, were pretty standard moves that the markets would have, as is the current levels. So the next segment, what I'm going to do is take a look at the actual numbers and try to make more sense of it. Hello, it is the 2nd of November 2011. Let's try to make sense of this daily silver chart. We can state that we're at this blue line right now, which works out to be that of the 200-day moving average, and this breaking below like this and going above would be that of a failed move. We can also state that we're having another test of this 50-day moving average. One of these was going to be a failure. Thus far, it's this one in here. And we can state we're below all these other lines. We're in a downtrend and all that. And sideways for the year, all that type of stuff. But in reality, there was only 2 significant down moves that occurred, one that happened in here and one that occurred within here, both for the same reasons, which is that of margin requirements, yet the actual physical commodity trades upon this. So therefore, in the next segment, what I'm going to do is take a look back at more towards the margin point of view.